Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. We are bringing the VRIC to you each and every week with our series of expert online panels. We have another great one lined up for you today. We've got Chris MacIntosh and Brad McFadden from Capitalist Exploits. We're going to be discussing all things commodities today. We're going to talk about gold and silver markets, energy markets, and more. Gentlemen, it's great to have you both on the show.
Good.
Great to be here.
Thanks,
Thank
Jesse.
you.
Great to be here.
So I want to start by getting a sense of where your head's at when it comes to the broad picture, the macro picture. What are the main themes and trends you're both currently paying attention to? And you can take this anywhere you like, whether that's financial markets, global economy, geopolitics. What are you watching right now that maybe you think more investors should be paying attention to? And Brad, I'll start with you.
Well, I guess where depends where you want to start the themes from. I think one of the big themes is energy. One could say, a higher theme is commodities, but energy in particular is one area we're very, very interested in, and all the sort of things that come off from that, be it energy, oil and gas services and tankers, whatever. It's been a area of the economy which has been starved of capital for quite some time. We can argue, well, probably 10 years or more. Um, and it's been dominated by the shale resources in the US, which we think are sort of reaching a mature phase. And it's going to be very, very hard to repeat what's happened in the previous 10, 15 years. So that would be one of the big things. And of course, if we get that one right, then the whole inflationary thing comes together. High energy prices will flow into higher inflation, so on and so forth. So that's where we see most of the opportunities, energy and energy related spaces.
Yeah, you're preaching to the choir here. The majority of my portfolio is in oil and gas equities. Chris, what are you looking at right now when it comes to the whole macro picture? What are you paying attention to the most?
Yeah, look, I mean, further to what Brad just said, we're actually not doing anything significantly different to what we've been doing since, gosh, well, so we started up our fund in end of 2019. We've had a few changes within the fund in terms of actual sort of biggish bets, right? And so what does that look like? Well, it's broadly commodities, as Brad mentioned. It's in particular fairly heavily concentrated towards energy. And what we're looking at is the um, we believe pretty much that we're topped out in the bond market, and that topping out of the bond market means rates keep going higher. It doesn't have to be linear, but either rates go higher or you cap rates and you let inflation run. Either which way, we've got a massive problem with respect to bond markets. And then at the same time, we've had this massive lack of capital investment into energy in particular. And so when we're looking for deep value, and that it's basically we're deep value guys, that's where we keep getting led towards. So none of that has changed particularly much. If anything, things have kind of just gotten better for us. And what I mean by that is the more fucked up the world basically is, typically often the better it is for a lot of a position. So for example, when we were getting long energy, um, we didn't have the conflict with Russia and the Ukraine. We didn't have the Nord Stream pipeline blown up. We didn't have the monetary inflation that always comes with conflict. While there's been massive monetary inflation and again debt markets and all that, which I've referenced, it's actually just been now accelerated. Um, in fact, people don't really know this, but if you take from um, like post-COVID, right? So there's a massive monetary injections in during the COVID period, and people talked about that a lot, where governments injected capital into the markets. Since then, we've actually injected more in this last phase than we did then. Um, None of this is anything but ultimately inflationary. So our positioning hasn't really changed a whole lot. We are still focused on major sort of trends unfolding, and that is largely around the bond market collapsing, and that can collapse over time. Like, it does. People think of collapse; it doesn't have to boom overnight. It can be a drawn-out process. And the way that typically has been, should we say, resolved has either been by default to some degree, or default in terms of inflation, printing the money to defray the debts. All of those scenarios historically have been very bullish towards hard assets. We also have this very unique environment whereby capital expenditure has been massively constrained from the last bull market. And we're actually not seeing it coming back. So, like, ordinarily, you'd have a situation where we would have by now quite a bit more capex coming into the market, and we're not really seeing that. There's a whole host of reasons why that's the case. In particular, it's all this woke DEI garbage and the climate change fraud. But so yeah, we're just following the trends that we've been following for the last 4 or 5 years, and then frankly, watching more unfolding that actually, I hate to say it, are more bullish for those positions, despite them being things that we wouldn't really want to be watching take place.
Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the 2 most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake Gold Mines, hit the link below to learn more. Now back to the episode.
Well, let's dive a little bit deeper into the energy aspect of things then. Where is it that you're seeing the most value in the space? Is it across the board, the big producers, all the way down to exploration? You mentioned tankers, Brad. Is that an area you're currently seeing value in? As well as offshore oil field services, all of those sorts of things, pipelines. Where are you currently seeing the most value in the energy markets? Brad, I'll start with you.
Oh, well, across the board, there's fantastic value. If you want to get really, I guess, on a microscope basis, where the absolute most value would probably be in oil services, and particularly in offshore oil services. And that's a way bigger field than just, buying a couple of oil rigs. It's subsea services. It's oil service companies in Singapore, across the board. It's a sector that's been absolutely bashed, and it's just not hard to find value there. If our thoughts in terms of the shale thing comes to fruition, in terms of the shale resources start peaking out, particularly in Permian Basin, it's getting very, very difficult to grow assets now, or grow production. There's going to be a lot more focus come into developing offshore assets. The thing is, there's just not the capacity out there to absorb any major increases in capex. As a micro example, people can perhaps relate to. There's only about 2/3 of the rigs in existence now than what there was about 15 years ago. So, and again, it's not just the rigs; it's capacity to perform subsea services, capacity to produce actually, pipelines, flotation devices, engineered platforms, you name it. It's just not there. just like shipbuilders. There's only about half, or thereabouts, half the shipbuilders, shipyards in operation now as there were about 15 years ago. So again, that's probably where the most value is, but one has to be patient. And of course, if you're just going to be focused on one sector, you're going to have observe a lot of volatility. But gosh, it's not hard, Jesse. I mean, just even think, oh, you know what, like I can't figure out what the best value is. Just buying Exxon is a pretty good start, you know, or something like that. But we're having a lot of fun because a lot of little nooks and crannies no one's really taking any notice of. One area has been the offshore oil services sector in Singapore. If you think it's been bashed in North America, it's been absolutely smashed, crushed in Singapore. One out of two companies went bankrupt, and they're only just recovering now. So that's where the major asymmetry is. But these are small things like $100 million market cap and less.
Very
in terms of shipping is shipping is the fleet is aging. When we talk shipping, we're mainly bullish on the tanker fleet, tankers, and bulkers, but probably mainly tankers. It's just not, the fleet's aging, and there's no ships being built. Virtually no ships being built. I think in 5 years' time, the average age of tankers is about 20 years. And in 20 years, they usually are sent to a beach in Bangladesh. Difficult to get a ship built because all the shipyards are full building LNG carriers or container ships, so on and so forth. If you got a bit of, if you're patient, it's not hard to find value.
And Chris, maybe you're both working together, so I'm assuming your thoughts are very similar to Brad's. So I would like to ask you about the bear thesis when it comes to the energy space, because I speak to a lot of people who are very bearish on oil, including those who invest in the commodities space, who are calling for much lower oil up ahead, who think that over the long run, when it comes to the 5-year, 1 decade time horizon, that oil will probably be much higher than it is today. But for the next 1 to 2 years, they see much lower prices. I spoke to Alex Craner yesterday, who's actually shorting oil right now. What is your time horizon when it comes to the energy trade, first of all? And what is your counter argument to the thesis out there that while a recession's coming, there's going to be a global recession that's going to crush demand for oil and thus lead to lower oil prices?
It's a very good question. By the way, I know Alex, he's a friend. He's also a trader. So this is important. We're not traders. We're long-term, deep value investors, and our time horizon is 3 to 5 years plus. Okay, so we don't care what happens in the next 6 months. I have no idea what's going to happen. I don't really care. I'm not playing that game. So what is the bear thesis? The bear thesis is on the demand side, right? So we have some crushing demand. And I think this is actually where most people are going to get caught out in the cycle. If you go back in our lifetimes, we've not, the inflation that we've experienced has always been demand led, right? It's been the growth of the Asian tigers, or it's been China or whatever. So there's always been this, when we talk about inflation, people go, oh, well, where's the growth? This cycle is not going to be led by that. While we can have that, and there's still growth within the emerging markets, this is largely going to be a supply constrained inflation and stagflation. And coupled with it is going to be this basically default on debt in largely in the Western nations. Again, you can default outright, or you can default synthetically via printing the money. Either which way, you get to the same end result. In that environment, it's a stagflationary environment. And so, yeah, you can have a decline in demand. You can have a shitty economy. But at the same time, you can have a lot of the things that we actually need are rising in cost. Supply chains come under pressure. We're already watching that transpire. So I'm making a case for the bull side, but basically the demand is that's the thing that people are focusing on, saying we're going to have a recession. That's going to crush demand. I would point to what is arguably one of the worst demand factors that we've had, which is back to the sort of 2020 COVID, call it what you will, that period. And global energy demand fell off way less than most people were anticipating. Remember, we had oil go negative on the futures exchange. So the market reaction was actually far in excess of what we had in terms of actual demand. And in large part, that's because people, finance people, office people, if you will, are now so removed from the reality of the world that is underpinning us. And that's true of farming, it's true of mining, it's true of production of almost everything. It's why you have these dolly birds in their leotards driving Teslas telling us that we've got to stop coal production, not understanding where their leotards come from or where the energy that just powered their Tesla came from, which is to say 30% of global energy comes from coal-fired power stations. So there's a disconnect there. Additionally, if you think about oil, over 50% of every barrel of oil has got nothing at all to do with fuel. It's the carpets that you're sitting on. It's the microphone that we're talking into. It's a whole host of things you wouldn't even imagine. And so, yes, that's the bear case, is that we can have a demand crushing event or something of that nature. And nothing's ever for sure, but you need to weigh it up with many other factors. I would point to the debt situation, global conflict, which we've been talking about for like 5+ years, and now every day that we're watching more and more of that transpiring. I've never ever seen any or read about any environment in the world where you've gone into a global conflict and it's been anything but inflationary. I'd challenge anyone to find such a situation for me. Is it possible? I guess anything's possible. But that's what history teaches us. At the same time, we're going into this environment now with debts that the world's never ever seen before. The levels of debts in the Western world in particular are levels we've never seen before. So I think we can make a pretty strong argument that on probability, this bear market that we've had and the extended period of it in terms of commodities is likely to be much longer in duration and much more violent on the upside going forward because of these major factors that that haven't existed before, or at least they haven't existed to the extent that they exist today.
Well, let's take a step back and look at the broader commodities complex, because there is the narrative that's been quite persistent over the past several years that a commodities super cycle is either already begun or we're on the cusp of one, that we're going to see a rotation from overvalued AI and tech stocks into real assets such as mining stocks. Of course, gold and silver bugs would love to see that happen when it comes to that space, because despite gold being at all-time highs, a lot of the miners have not performed up to people's expectations. But we'll talk about gold and silver in a moment. But first, do you both also see a very large bull cycle for the commodities sector as a whole, kind of across the spectrum, everything from copper to uranium to the precious metals, etc.? Is it not that simple? Is it more complex than that? And if you do think we are going to see a boom in a number of commodities, which ones, aside from energy, do you think stand to benefit the most? And Brad, I'll start with you.
Right. Okay. Here's a complication. All right. Now we had the GFC, and one of the big reasons why GFC was so bad is because they let Lehman's fail. if Lehman's hadn't failed, it probably wouldn't have been as bad as it was. You said how we know what the GFC was like. Now, every central banker knew that. You let a big merchant bank like Lehman's fail. What's going to happen? Now, remember, from 2009 onwards, there was always the term, it's the next Lehman moment. What was it? Deutsche Bank. Yep, next Lehman. It's like now, and then it was Credit Suisse. UBS might have been in there, and so on and so forth. Now, given that every central banker knew what would happen if you let a merchant bank fail, do you think they were going to let Deutsche Bank fail, Credit Suisse fail, so on and so forth? No. And as a little saying, the more you look at the future, the more it changes because you looked at it. So if we take that little lesson, all right, very, very important, but let's take that and apply that to the energy markets, which is sort of applicable to the broader commodity market, I guess, as well. But so we had first of all, we had the collapse in oil prices from 2014 to 2016, wasn't it, thereabouts, where oil fell from $100 a barrel down to 30 odd, thereabouts. Now, that was largely because OPEC didn't come to the party and rein in supply, rein in production. Do they want to repeat that again? No, there's a complication, of course. So we're not going to have massive increases in production coming from shale like we did before. But does OPEC want that to happen again? Another complication is with the whole Russian thing, and now the BRICS getting together, and there's not the relations between let's say Saudi and the US has deteriorated dramatically. The Saudis not going to help out the US. The Saudis supply way more oil to China than they do to the US anyway. So, and then the other thing which happened in COVID, remember the Russians and the Saudis didn't come to an agreement. Oh, when was that time? What was that date, Chris? There was a date where they're having a meeting and they didn't agree on production cuts, and that's when the price of oil went to, well, West Texas went negative. Brent went below 30 odd bucks. If they let that happen again, and knowing what they did or didn't do, do they want that to happen again? I don't think so. So my thinking is that OPEC Plus, including Russia, will be a lot quicker off the mark at production cuts as and when they're required. They won't try and go into a pricing war with the shale producers, so on and so forth. So there's a complication there. Now, getting back to your broader question in terms of commodity super cycle, well, I guess it depends on the commodity you're talking about. I think in the energy space, there's an easy case to make for prices not coming down materially because there's been a lack of opening up of new coal mines. We've got no new supply really coming online in terms of oil and gas. You've got US shale probably maturing a lot more than everyone thinks. Copper, probably the same sort of story in terms of ore grades deteriorating, no new copper mines coming online. The sort of other battery metals like nickel and lithium, etc., that's quite specific. It's a whole different story. I think there's oversupply there. But your traditional commodities, the ones we really need, there's been a lack of investment that's going to come back to bite. So there's two aspects to it. One is what Chris has alluded to, and that's a monetary aspect. The more you print money, etc., the higher the price of a commodity is going to go just by default of it not increasing in supply. Then another issue, of course, is that it's going to be very, very difficult to increase the physical supply of the stuff because there's no new supply of stuff coming online. It includes uranium as well. So I don't really want to get. Chris and I are very, very cautious of, wary of these sort of buzz phrases like super cycles and stuff like that. It just, there's a lack of supply coming online. Wherever the price is going to go, it's going to go. Is it going to rival what we saw from 2000 to 2010? Wow. if we just do half that, it'd be pretty dramatic. But
It's
definitely,
about
look,
really
yeah.
just
Go ahead,
kind of
Chris.
just about buying deep value assets and where you get led. So it's like it's not like we came out and said, "Oh, we're oil and gas guys," despite us being extraordinarily bullish on oil and gas. It's like, where does the value lie? And we're agnostic. We'll go anywhere. We'll buy baked beans if it makes sense. We don't give a shit. We just see how to make money, and that's where it's like we're led into these sectors which have been basically mispriced, and often you have a narrative behind it which has put it in that position. So if you think about the narrative we've had, I mean, Jesse, you've come from Canada. It's like, woke capital of the world where renewables are going to take over, and that's true, and largely in the Western world. And so that narrative is very dominant. It's falling apart now. But it was easy to see it was going to fall apart. Anybody that can do for fifth grade math and had a brain could see this is not going to work. It's not mathematically possible. And so here we are. And, so that leads us into things like coal and a lot of the things we talked about now. But, you have there's other things that we will look at. Argentina is a good example, so we bought into Argentina in, what was that, Brad? October
20, sort of late 2021. Yeah, 2021.
21. And it was, really just the market speaking to us, saying, you're an idiot to not see there's some extraordinary value here, and there's something going on in the charts where you can see there's like if you wait too long for 100% certainty on something, you're never going to get that asymmetry, right? And I think it's Druckenmiller talks about this, like you can't make decisions based on 100% certainty. You simply can't, because by the time you get to 100% certainty, you're going to get 100% pricing of the asset that's much more accurate and correct. In any event, so there's a lot of things that we will go into, which represent deep value and have that asymmetry. And asymmetry is two things, right? One is a big part, which people forget, is about risk mitigation. It's about how much can it go down. Coal's a good one. We started buying coal stocks at 2-3 times PEs, and they're paying out double-digit dividend yields, and they can. Where's that company who could buy back its entire free float with about 18 months of free cash flow? Like, where do you even find companies like that? It's nuts. And you go, how is that possible? It's possible because we've been told by Greta and the people like her that we're never going to use coal again. Despite it being about 30% of global electricity generation. And despite the fact that coal isn't like, there's also, there's coking coal, it's thermal coal, so fine. How are you going to build anything without steel? People are like, what's steel got to do with coal? Exactly. People are so like, they're so far removed from the world that underpins them that they can't even understand how it works. And that's the situation where you have these setups where you can just, feed at the trough. And so we try and do that. So it's led us into largely in the commodity space, but it's led us into other things. We've got, like I said, positions in Argentina, which have done very well for us, as well as
Greek equities, just for good measures. There's some stuff in Israel we've got. There's a whole, the more toxic stuff is, or at least how it's perceived by the average investor, the more we're interested in it. So, yeah.
But there's a lot of stuff like it looks so toxic, and then you go and you look at it, and you're like, what's going on? Why is this like so cheap? There must be. Is it a Kodak moment? Are we really never going to use X, or is this country or this sector or whatever really going away? And then and you look at it, and Brad and I will often look at each other and go like, are we being stupid, or what's going on here? I mean, if we just take like oil and gas, right now, I thought, well, it was 2023, I think the numbers are out. Like, we're consuming 6 barrels of oil, and only one's being replenished. So it's kind of like having the pantry, and you're like, take 6 cans out, honey, put one in. It's like at some point you're going to be hungry because you're going to open the pantry and there's nothing left. And the problem that you've got in commodity markets, as you'd know this really well, these are capital intensive spaces. It's not like you can just turn the tap on. In order to actually get that supply, often you're looking at multi-year timeframes just to get to find a resource, to mine it, to build the infrastructure, to, if it's a gold mine, to, fight the greenies, build a highway in, build a mine, everything else. If it's oil, extracting it, all this sort of stuff. It's not something you can just go, oh shit, we fucked that up. Guys, let's turn the tap back on. It's like, all right, call me in 10 years, we'll be there.
It
So
takes
that's
years.
what also gets you into these wild price movements within capital intensive markets, which will look at long cycle assets. So that, back to the whole super cycle thing, I think it's one of those, but who cares? Doesn't really matter if it is or isn't. What we know right now is we have in front of us this extraordinary setup of supply constraints. We've got the monetary inflation. We've got geopolitical conflict, which also often affects supply chains. And you go, okay, it just deserves an allocation. And then the question is just around position sizing. How much do you want? Is it 5%, 10% in that sector? And that's just portfolio management.
Well, I want to talk about gold and silver as well here, and get your thoughts. Obviously, silver hitting a nominal all-time high. Do you think there's a lot of value potentially in the gold mining sector? Obviously, this is an area that's fraught with peril, especially the further down you go to the juniors and explorers. The very few of them ever really make it. So it takes a tremendous amount of time and research to really look at that aspect of the gold mining space. Where are you looking for value in gold mining, and maybe silver as well? Do you see silver as a deep value play? Because it is quite a hated commodity in the sense that there are a lot of people who got into silver and are extraordinarily frustrated with it. And I get comments all the time whenever I discuss silver on any video that it's the worst trade ever. Silver's never going to do anything. I wasted all my time and money stacking silver. What are your thoughts on both the gold and silver? And maybe we'll focus on the miners as well. Brad, your thoughts.
We would have thought gold and silver would have been materially higher by now. I mean, gold should be above $3,000 an ounce, even higher. Silver should have been way above $30. It's been amazing to us how it hasn't happened, but maybe it's playing catch up now. Certainly, if those gold prices go materially higher, then gold equities are cheap. We're not so cheap now, but I guess it's a call on where we think gold's going to go. It's a difficult one, Jesse. I mean, in terms of stock picking, good luck on that one of gold miners. I mean, it's, we're not mining engineers. We're not, interested in the intricacies of these mining companies. It's more to get the sector right. So yes, we've got a 5-10% allocation to gold miners, silver. There's nothing special on that. What's catching our attention at the moment is platinum, palladium. I mean, it's bizarre how that's supposed to be way more rare than gold, and then it's like, hang on, well, gold's more expensive than platinum, palladium. It's like, huh. And the other one is rhodium. But look, yeah, they're going to go materially higher, we think. don't give us a time frame on it. Obviously, within the next 5 years. We've been saying that for a while, though. So I don't know if I've given you anything unique in terms of that. Um, yeah, sometimes it's a tough one. It really is, because it's really, as I said, a call on where gold and silver is going to go. That's what it comes down to.
And Chris,
Yeah,
maybe you could
gold's
expand
interesting.
on that as well. Yeah.
Gold is like, I mean, it's like we were talking about it this morning, Brad. It's been hitting an all-time high in dollars. Now, it's been hitting an all-time high in other currencies for a long time, and no one really cares. Asset allocation
No.
from passive funds, your big boys, your Vanguards and your BlackRocks and your State Streets and your Fidelities and all these big, huge passive capital allocators, they got screw all in that. So you go, who's the buying? Well, the buying is actually all coming from central banks, and those central banks are largely dominantly non-Western. China, Turkey, interestingly, actually Serbia, where you are. But yeah, so we've got central bank buying. The retail crowd are nowhere near it. Not only are the retail crowd nowhere near it, but your institutions are nowhere near it. So the way I think, well, firstly, gold equities is kind of like it's your, or at least supposed to be your alpha to gold. Okay. And I think you own it for different reasons. You own gold as an insurance policy, and as capital, and you own gold equities as a kind of a flutter on capital shifting into that space, which I think we'll get there. But it's not something we're pressing right now. We've got, like Brad said, 5% allocation towards that. But if you think about it from another perspective, think about if you were a typical Westerner and you trot down the road and you speak to your financial advisor, what are they going to do to you? They're going to say, "Oh, Jesse, how old are you? Oh, you're X number of years old and you've got, I don't know, a wife and 2.4 kids and a mortgage and blah, blah, blah. We think this is what you should own." And they will give you some variation of a 60-40 equity bond split. And they'll tackle your equities into maybe a little bit in emerging markets, because you know what? You're young enough to take some risk. And you need some growth. So we'll chuck you into the NASDAQ, which is you just might as well throw your money into the fire. I mean, if you're buying the NASDAQ and you're buying the S&P, you're basically buying the Mag 7, because they're the highest concentration within the S&P that we've had. We've never had that kind of level of concentration, not even in the .coms with Cisco and all that garbage going on. So when people think they're getting diversified by buying the S&P, guess what? They're not to the extent they think they are. So that's basically your 60% equity split. Now you got bonds. Well, what are bonds? Well, they're a bug in search of a windshield. So now you think about that as an asset allocation. How much of that is in energy, gold, any of these things? Very, very little. Energy, when we last looked at it in the S&P, Brad, was what, 3-4% weighting?
Yeah.
Like, it's the lowest it's been pretty much in history. Going after Russia, one of the major suppliers of energy in the world, going after Iran, potentially, destabilizing the Middle East, and people are like wanting to be short energy. I'm like, I don't know if that's a great idea. Again, we haven't even talked about the monetary side of things. Anyway, so back to the gold thing. Just a rotation of a small amount of capital out of your 60-40 bond split structure into stuff that doesn't even have to have gone up. It can have just gone nowhere, is going to become attractive. If you go and you have a look at this market sell-off we've had in the last, month, guess what keeps making highs? Gold. So, like Buffett says, the market is a mechanism for transferring wealth from the impatient to the patient. You need to be patient. And our stance is that don't over allocate. So like don't go and be a gold bug and put all your money in gold and say, champion gold. It's not, investments are not there to be married to. They're just things. Don't get emotionally attached to them. Don't get all Yeah. Decide what your weighting is and be prepared to wait it out and constantly revisit why you bought it, because you can get it wrong. And if you do, and you find some flaw in your analysis, you go, okay, it's a bad idea. We've messed that up. Let's get out. And that's much easier to do when you've got a smaller weighting, but I think the risk that people run is that they get so emotionally attached to something, and that's easy to do when you have a high weighting in it. If you're 20, 30, 40, 50% weighting, you really want it to love you. And the other danger actually there is when it does love you, you don't ever want to get rid of it. So we like gold. We think it's deserves a position in the portfolio. We like gold equities. Again, we think it deserves a position in a portfolio. So
Of course, it would be easier, Chris, if we're in 2001 and gold's at $251 an ounce and no one wants to touch it, and everyone says, "Oh, gold's got no place in the new economy." It's old economy, it's dead. And look, yeah. So if we have any reservations about gold, it's because it's not seen as toxic waste. But yeah, one
just occurred to me.
Yeah, go ahead.
So a lot of media that we get is dominated by Western people, Western interests, Western financial institutions, you name it, at least within the finance space. Within that space, you go, what's done well? Well, what's done well in the West and within the finance space has been bonds. So you're not seeing a whole ton, even though they kind of topped out. You look at the charts from 2016, it was pretty much that's where it topped. Then we had the whole COVID fiasco, finally got a bump there, but really the trend has been negative. Not like massively so, but enough to hurt. But our broad equity markets have just kept printing, the Mag 7. And so people are very, very focused on that. There's very few people who are focused on the underlying. It's like we talked about, Greta driving her Tesla and not really understanding where coal comes from or where leotards come from. If you take the same sort of analogy and you look at emerging markets or non-Western markets and their weightings, you've got, remember, Brad, we were looking at this. You had like the Mag 7 was the same.
Yeah,
it had higher. It was much higher than all of the markets of Japan. It was Japan, France, China, and the UK. You could throw all those markets in, and the Mag 7 was bigger than them.
Yeah, and Australia and Singapore. Yeah.
Yeah, it's like you don't have to be a genius to figure out that's not really making sense.
There's another stat, Chris. All the energy stocks in the world, the S&P World or Bloomberg World Energy Index, which take BP, Shell, Exxon, Petrobras, every energy stock.
Yeah.
Its market cap was about 13 trillion. Is that right? Yeah. And what was it? Nvidia was half that market cap. Was half the market. Nvidia, I forget the exact figures, but Nvidia was half the market. So I looked at it a wee while ago. Half the market cap of all the energy stocks in the world. It's just like, hey, it's like
it's a little bit like. Jesse, have you ever spoken to our mate Cuppy?
I haven't. I'd like to interview him, but I haven't yet.
Yeah. He's
I follow his work.
He said something the other day. What these guys were pontificating on around like what the Fed's gonna do and what the rates are doing here and there, and they're sounding pretty smart. And they're like, "So what do you do?" Cuppy goes, "I buy what the Chinese are buying." Does it in this flat? Now, if you take that a step further, what the Chinese are buying is infrastructure, ports, mines, stuff. Okay. Now, if you take, and here's a little stat to give you how massively divergent this is. United States share of global GDP, it's about 15.2% in terms of purchasing power parity. Okay, so 15% of global GDP. China is 19 point something, can't remember. Okay, so China is already much bigger in terms of percentage of global GDP. This is like this stuff, right? Making stuff, production. Now you look at the market caps. US equities account for about 64% of global market cap. China accounts for 2.6%. So China's bigger in terms of what they like. Think about it as making stuff and the value of that. They're bigger in making stuff and their value is fractional. The US isn't making shit. It's basically all export. China's making it. But the market cap of their companies is 63%. So, and then if you dig into what that is, well, it's kind of your Mag 7. It's all, and amongst other things. So you have all of these sort of setups which are easy on a fundamental basis for you to look at and go, you know what? I don't know when that ends or if it how it ends, but it doesn't make a whole lot of sense. What is the underlying behind it? And it's to the point of what Cuppy was saying, and he just said it in one little snippet, but it's basically that's the thinking behind it. Buy what China's buying. They're buying gold. They're buying oil. They're buying commodities. They're buying these things. And that's the underlying value. And now that would make no sense if they were expensive. But as we've just been talking about, you can buy these coal mining companies for like low single-digit PEs. Why wouldn't you? Compared to Nvidia at, what's it, 78, 79 times or something? I mean,
Well, Chris, it's a story of physical assets versus financial assets. Well, that's what it comes down to. And maybe, Jesse, that should have been what I started off with, where you know, in terms of the big theme, you know, we're really interested in, and as Dennis Gartman used to say, stuff that hurts your foot when you drop it on it, you know, like physical stuff as opposed to, you know, financial assets. And, you know, Magnificent Seven could be argued as more financial assets and physical stuff.
Well, I want to end on the concept of investing internationally, because the vast majority of people don't really have a grasp on how to even start going about doing that. Most people feel most comfortable investing in their country's particular stock market, whether that's the TSX or NASDAQ, et cetera, if you're in America or Canada. I think most Canadians feel quite comfortable investing in the American market, but when you start talking about Israel and Argentina and places like that, they immediately kind of, whoa, how would I even start with all of that? So when it comes to looking at the world and the various stock markets that exist, the various exchanges that exist around the world, if somebody's just starting to look outside of the North American markets, how do they start? Where's the best place to do their research? Obviously, this is a highly personalized question depending on the investor and their goals. But how would you recommend somebody set out starting to take a look at the rest of the globe outside of North America? And Brad, I'll start with you.
I'm the opening batsman, am I? Gosh, Jesse, you know, it's a tough one because we just
Canadians don't play. Do Canadians play cricket? Do you guys play cricket?
No,
that was because that was a reference to cricket. Like
yeah,
you
sorry,
have
okay, well, there you go.
an opening batsman is the first.
Yeah,
probably played baseball.
My dad, yeah.
Every
anyway,
time.
So look, the hard thing is we do things. We've been doing it for a very, very long time, and we just do it. We just do it, and try to explain to someone how to do it. I don't know. Look, to us, investing globally, buying a stock on the ASX, Australian Exchange, or Singapore and Japan or Hong Kong, it's just as easy as buying a stock on the New York Stock Exchange. We've been global, been doing things globally for like 20 odd years. So I don't know, Chris, help me out here.
I think often people, I think a lot of it's, look, the risk is people don't understand often the risk they're taking on. Take, for example, you can have any company listed on the New York Stock Exchange, and your average American, and I'm not pointing fingers, I'm just like, your average person who maybe isn't particularly well traveled or hasn't done this before will just happily buy it. Oh, it's on the New York Stock Exchange. It's an American company, not necessarily knowing what the company does. I mean, we've got some companies that are listed on the New York Stock Exchange. Take sometimes some of the shipping stocks. Are they actually in the US? No, they're goddamn ships. They're sailing around the world, and many of their operations are nowhere in the United States. They've just gone and listed there because there's better liquidity on the New York Stock Exchange than there is on some other exchanges. But they'll just as happily change their listing if it landed up being a better deal elsewhere. And so, you know, that's you could even say Apple. Like, where is Apple? Okay, so they're based low in California, so called. Their operations are in China. They got a little bit of R&D in California. They route most of their stuff through Ireland for tax purposes, and then through a Cayman entity. So they're kind of like, they're actually, it's like, are they really American? And that's like a very American company, right? So I think that a lot of it is people will just ostensibly look at something and go, that's scary, right? Or because I don't know it. Oh, it's on a different exchange. Oh, it must be scary. You know, am I going to lose my money because I bought it on the Singaporean exchange? And not really understanding any of it. So how do you go about it? Educate yourself. I mean, just begin educating yourself. It's not that hard. We've got the internet. You can, two fat thumbs and a phone, and you can like get a lot of information. It's not the stuff when Brad and I came into the business, we didn't have that capability. It just didn't exist. So you were getting research reports from places, but it was back in the paper days.
You had to go to the places, Chris. You had to fly to the places
Getting
and
stuff faxed or going to places. Yeah.
Interview management and what have you. And it's a lot of, you said, it's a lot easier now than what it was back then. Look, Rome wasn't built in a day, and you guys, we've been doing this for actually it's more than 20 years now. Probably 30 odd years. It's just, baby steps. Just start familiarizing yourself with other markets, exchanges, and if you're interested in, say, let's say, shipping, let's say all the services, start looking at opportunities elsewhere in the world where oil service stocks are listed. Well, that's usually Norway and Singapore. If you're interested in construction machinery, well, why not have a look at Japan? There's some really interesting things there. Look, there's lots of info out there. There's great websites, things like investing.com, and I think FT's got a great website. What else is there, Chris? There's Trading View, and there's a whole list of them. So yeah, as I said, as Chris said, it's a lot easier now than what it was. We had, if you didn't have Bloomberg in the old days, you were pretty much buggered. That's for sure.
Well, gentlemen, this has been a fantastic conversation, start to finish. I learned a ton. I'm sure the viewers did as well. Before I do let you both go, talk to us about Capitalist Exploits, what it is you do there, and where's the best place to find both of you online. Brad, you can start here again.
Yeah, well, it's capitalistexploits.at is website. We look for opportunities globally. It's not just energy, it's or resources, it's opportunities globally. Really out of favor stuff we're looking at. I don't really have any presence on Twitter or whatever. It's just capitalistexploits.at.
And Chris, where's the best place to find you online? And maybe if you could provide a bit more details on Capitalist Exploits. Is you guys have a fund? Is that open to the general public? Is that only institutional? How does that work?
Yeah, so okay. The way it works is that we started up writing notes to clients, which became what is now called the Insider Service. on capitalist exploits. So there's a free notes you can sign up for, but we do have a paid service there, which is us basically talking about what we're doing with our and client capital in what is called Glenorchy Capital. So that's for accredited investors. That's our sort of asset management arm. And yeah, as Brad said, we look around the world for opportunities. We talk about what's going on in the world because all of these things matter from a capital allocation perspective, and where, I mean, even like, your question around looking, say, outside of the US, I can't think of a time in my life where it's been more important to actually understand what's going on in the world and have some optionality around that. This is, I'm a student of history. We have these long cycles. One of the long cycles that we're at the end of now is that 100-year debt cycle. Interestingly, we're also at the 250-year revolution cycle. Now, is that come now or in 10 years' time? We don't know, but certainly sort of feels a bit like now. So these things are important because what you get is massive change. Typically capital rotation, you have maps get redrawn. That's what happens in this time. And so I think there is a danger for many people to being quite sort of myopic and just sitting in wherever you happen to be, especially if you're in a Western market, and not having at least some diversification out of that from a jurisdictional point of view, forgetting about sectors we talked about and maybe being long the S&P or whatever. And that's kind of our forte. It's what we've been doing all our lives. So it just feels normal, but it's quite exciting for us because we're watching all of this roll out. It feels to some degree like we've sort of been built for this this time, being students of history and watching and understanding cycles. Anyway, so we talk about all that sort of stuff.
Great. Well, I'll put a link in the description below to the Capitalist Exploits website so people can check that out. Gentlemen, it's been a blast. Thank you so much for coming on the show.
Great. Thank you, Jesse.
Thanks, Jesse.